Dear students, welcome to Module 13, Cash Flow Based Valuation. The first problem we are going to look at is question 1, identifying and computing net operating assets and net non-operating obligations. So we have balance sheet and a statement of earnings. We have to complete the entire question in Excel. So this is our balance sheet. This is our statement of earnings or statement of income. So we have to compute net operating asset, net non-operating obligations, and few other questions here. So this question does not give us a link to an Excel. So we have to actually open an empty Excel and work there. Let me open an Excel file. I'll call this module 13, homework. I'll copy the information I have. So copy up to this. It doesn't look very nice. Undo it. Okay, let me copy from here. Control C. Okay, this looks much better, but this did not copy correctly. So I'll undo it again. I will copy from here up to this, Control C. And I'll keep some spaces, rows empty. So looks nice. And then I'll copy this individually. Maybe just this consolidated balance sheet. Consolidated balance sheet. February 13, January 28, February 3. $1 million. Okay. Now I want to enlarge or increase the width of this column. So what I can do, I can push on this letter A, which is the heading of this column. So this will highlight the entire column, and then I can move my cursor until I see this. See how it changes, and then I'll double click. So it will auto resize this entire column. Now remember, I could not copy then the last item. So I will copy this individually. Okay. I have to copy. Okay. And then total liabilities. Okay. Again, I'll highlight this, double click. This did not work for some regions. So that was our balance sheet. Now consolidated statement of earnings. I'll copy from here to this. So I am going to, let's say, paste here. And again, copy. Just the text. Control C will copy. Highlight, Control C will copy. Control V will paste. Okay. I think we are good. We should be able to solve our problem with this. So this is our balance sheet. This is our income statement. So what we have to find out first is we have to calculate net operating assets. So A, you have to find out net operating assets. I already copied it. So I can double click on this and Control V, paste it. So this will paste only the text, excluding the formatting. If I directly paste on a cell, for example here, so sometimes the formatting will not look nice. Okay. Now to calculate net operating assets, what we need is net operating assets is equal to operating assets minus operating liabilities. So some of the information that we are going to use in this module comes from module 3. For example, this net operating assets. It has been discussed in module 3. Let me show you. So if we go to module 3, page 16, you'll see net operating assets is equal to operating assets minus operating liabilities. So now how do I calculate operating assets and operating liabilities? So on the same page, you will see that operating assets include these items. So operating assets are those assets directly linked to the company's ongoing, continuing business operations of bringing its products or services to the market. The company needs these assets to operate normally, and they typically include the following. Similarly, operating liabilities are liabilities that arise from operating revenues and expenses. That is relating to the core business activities of the company. Examples include. Now, there is another thing you need to understand is other assets and liabilities. Other, for example, in our case, we have other assets, right? So how do I know it is operating or not, non-operating? So companies typically report other assets and liabilities both as current and long-term. We assume that these are operating items unless information suggests otherwise. For example, details in footnotes might reveal that other consists of non-operating items. So let us continue our work. So operating assets will be, so we have to add all the operating assets. So there are some formulas built into Excel spreadsheet. One of them is sum, S-U-M, which adds the cells I'm going to write inside. So, and it is asking us to calculate net operating assets and net non-operating obligations. We are working on net operating assets for now for 2019. So operating assets, again, these are your operating assets: accounts receivable, inventories, prepaid expenses, so on and so forth. So first of all, I have to go to balance sheet. So receivables, so this is one under 2019. I'll enter a comma. Inventories, yes, comma, this is other, yes, because we don't have any footnote that says it is non-operating. Comma, property, plant and equipment, yes. Goodwill, yes. Other assets, yes. So these are all operating assets. And then operating liabilities. So operating liabilities are, again, some formula. You'll see accounts payable, accrued expenses, unearned or deferred revenue, income taxes payable, deferred income tax liabilities, pension and other post-employment obligations. So operating liabilities, scroll down to find out the liabilities. So it starts with accounts payable, comma, accrued salaries, sales taxes, deferred revenue, income taxes. We will skip that. That is not part of operating liabilities. Other accrued expenses. So, and then that is not deferred income taxes, other long-term liabilities. So I forgot to highlight this one. So let me do it again. Sum. So I'll start with accounts payable, comma, accrued salaries, comma, sales taxes, comma, deferred revenue, comma, income taxes, comma, skip debt, other accrued, comma. So skip total current, skip debt, deferred income taxes, yes, other long-term, yes. So that's all. Now we have to subtract operating assets, operating liabilities from operating assets. So 25,426. The second part of the question is net non-operating obligation, NNO. So I'll write down here, net non-operating obligation. So net non-operating obligation is your non-operating liabilities minus non-operating assets. So far we have seen operating assets and operating liabilities. Now, non-operating assets and non-operating liabilities. I'm going to write this down here. Net non-operating obligations. Non-operating liabilities minus non-operating assets. So these are our non-operating liabilities. Short-term and long-term debt that we excluded in calculating operating liabilities. Lease obligations, interest payable, dividends payable, discontinued or held for sale liabilities, derivative liabilities. These are our non-operating assets, cash and cash equivalents that we excluded when calculating operating assets. Marketable securities, discontinued or held for sale assets, derivative assets. Okay, let's go do that. So net non-operating obligations, we have to find out non-operating liabilities. So non-operating liabilities, again, sum so our short-term debt, current portions of long-term debt, long-term debt. These three. Okay. Now, non-operating assets. Again, sum formula. Our cash and cash equivalents. So that's only one. So I need to enlarge this cell. So I will double click on this. So it will be non-operating liabilities minus non-operating assets. So note that in the question it says, complete the entire question in Excel and format each answer to 2 decimal places. Then enter the answers into the provided spaces below with 2 decimal places. So you need to highlight this, go to increase indent to 2 decimal place. Now question B is asking us for the fiscal year ended February 3, 2019, show that net operating asset, which we already calculated, is equal to NNO, which we also calculated, plus stockholders' equity. So let's see that, if that is what it is. So B, net operating assets is equal to, we have to show net non-operating obligations plus shareholders' equity. So shareholders' equity is this. So 25,426 that we found out before, 25,426. So that is correct. We showed. Now, compute net operating profit after tax for the year ended February 3, 2019. Assume a federal and a state combined statutory tax rate of 22%. Also consider impairment loss to be non-persistent item. Exclude the after-tax amount from your NOPAT calculation. So NOPAT, net operating profit after tax. So we can calculate NOPAT as net operating profit before taxes, in short NOPBT, minus taxes on operating profit. This is also on module 3. You'll see net operating profit after tax, net operating profit before tax minus tax on operating profit. Similarly, to calculate taxes on operating profit, we need tax expense plus pre-tax net non-operating expense, pre-tax net non-operating expense multiplied by statutory tax rate. And we can calculate net operating profit before taxes as our sales minus, you'll see, net sales minus cost of products sold, cost of products sold minus operating expenses. So first we need to find out then net operating profit before taxes. Now, here you will see what are considered operating items on the income statement. Previously, we saw what are considered operating and non-operating for both assets and liabilities on the balance sheet. Now, operating and non-operating on the income statement. For example, these are operating line items, and these are non-operating line items. So for my question C, net operating profit before taxes. Now, this question also tells us that impairment loss is non-persistent. So what that basically means, we have to exclude it in calculating net operating profit before taxes, but we have to include it in pre-tax net non-operating expense. Okay, so our net operating profit before taxes, or NOPBT in short, is our sales, which is these, minus our cost of goods sold, which is these, minus our operating expenses, excluding the impairment loss. So we cannot subtract this total operating expenses directly. We need to exclude this amount. So I will enter the sum formula again, sum, open a parenthesis. So this selling, comma, this depreciation, this two. So this is my net operating profit before taxes. Now we have to find out taxes and operating profit. To find that out, we need to first calculate pre-tax net non-operating expense. So pre-tax net non-operating expense will be Here it explains interest expense on debt and lease obligations, loss or income, debt issuance, retirement costs, interest and dividend income on non-strategic investments, gains or losses, other income or expenses if reported separately from operating income, usually following the operating section of the income statement. So let's see what we have here. We have operating income, and then we have interest and other income expense. We have nothing for this. We have interest and investment income, yes. And then we have interest expense, this. So, so this one is basically the sum total. This is the major category for all these, excuse me. I misspoke. So what we have here is we have in total, so interest and other net. So all these are after operating income. So see, it says other income or expense if reported separately from operating income. Yes, they're reported separately and also usually following the operating section of the income statement, and they're also after operating income. So we know all of these are non-operating expense. So we can actually take these total, and we also have to add this impairment loss that we excluded from operating. We have to add to the non-operating. So let's do that. So sum of my impairment loss, comma, this net interest and other net, close. Now, tax on operating profit will be my tax expense, which is these, plus pre-tax net non-operating expense multiplied by the tax rate, which is 22%. So this is our tax on taxes on operating profit. Now, net operating profit after taxes. So not before, after. So this will be just my net operating profit before taxes minus my taxes on operating profit. Okay, so I need 2 decimal places. So we are good so far. So that is the end of question 1. I'll rename it as 1. You can double click on this to rename. Let us move on to the next question. Question 2. So we have some information here. We have to estimate the value of a share of Home Depot's common stock using the discounted cash flow. So we have to solve this problem in an Excel again. So I'm going to copy this. Control C. I'll add a worksheet, rename it as 2. Now Control V. And then I also have these assumptions. So I'll copy this. Let me paste here. It doesn't look very nice. Okay, I'll undo it. I'll paste here. Let me copy again. Control C. Okay, I'll undo this. Let me copy just from here. Control C. Okay. And then I can highlight all these and double click to resize them. So you just have to get used to using the Excel spreadsheet. With practice, you will become very used to it. Now I'm going to write down assumptions here. So estimate the value of a share of Home Depot's common stock. So I'll also copy these. See, or paste here. Is, and then this is too much space. So what I'm going to do, highlight from this row number like 1, 2, 3. So I'll go from 2 to, let's up to 12, and then come to any border. So I can move my cursor here, doesn't matter, as long as I see this symbol. This symbol, this appears when you move your cursor close to any border. Now double click on this, it will resize all of the rows. Similarly, all of the columns if you highlight columns. So we have to use DCF, discounted cash flow. So chapter 13 discusses the DCF in detail, dividend discount model. So as per this model, what we have to do, we have to find out free cash flow to the farm, FCFF, which is equal to NOPAT minus increase in NOA, which is net operating assets. So I'm going to write this down. So under DCF, or discounted cash flow, free cash flow to the farm is equal to your NOPAT minus increase in net operating assets. So this is actually from module 13. These are from module 3 actually, this information. So let's see how can we calculate free cash flow. So you have to calculate free cash flow to the farm, and then these are the steps. So we have to forecast and discount. So, and then a few other steps. So let us, excuse me, let us complete them one step at a time. So first, increase in net operating assets. So in 2019, we'll start with 2019 because we cannot calculate increase in 2018 without knowing 2017. And I will actually delete the dollar symbol from here. So in 2019, enter equal sign. So increase in net operating asset. So this is our net operating asset minus 2018. So 2019 minus 2018 net operating assets. And then I'll hit enter or push the enter key on the keyboard. And then because these line up, in sequence as this. So I can actually pull this across up to this period. And this formula, the original formula that we manually entered, will be copied. For example, if you double click on this, you will see it is picking up the right two cells. So similarly now, free cash flow is NOPAT for 2019, NOPAT, which is given to us. So this is our NOPAT for 2019, minus increase in net operating assets, which is this. So hit enter, and as before, pull across. Now present value of horizon free cash flow. So to calculate this one, what we have to do, we have to use this formula. So this comes from present value formula. So it is equal to your 1 over 1 plus your RW raised to the power T. So this formula is, it is explained to you that RW is a weighted average cost of capital, which is one kind of discount rate. So this RW is the weighted average cost of capital, or WACC. You have heard this term many times, I'm sure. And T is the number of year. Is it, if it is 1 year for which we are calculating the present value, the value of T will be 1. If it is for the second year free cash flow to the firm for which we are calculating the present value, it will be 2. T will be 2, and so on and so forth. So let us calculate that. So RW is our discount rate. In this case, this discount rate is weighted average cost of capital. So you can also write down that it is discount rate. So let's go back to our Excel, and it tells us this is our discount rate, 7.85%. So enter equal, select the free cash flow to the firm, divide by open parenthesis 1 plus your discount rate. So discount rate is the same for all years. So what we are going to do, we are going to log this cell. So in some keyboards, you can press just F4, and then you will see this $sign appears before the letter B. So letters are the column headings, and before number, these are row headings, row names, or row numbers, whatever you call. So both the column and the row is locked. So that basically means the cell is locked. And close, raised to the power. So this hat sign is raised to the power. I will choose this cell for now. I will replace this as number 1 because this is the first free cash flow we have for which we are going to calculate the present value. Again, if you cannot, if your keyboard doesn't work, meaning if you press F4 and the cell is not locked, B9 cell is not locked, you can manually enter $sign. For example, dollar once here, and then dollar another time here. So they're the same. Hit enter. Now remember, this should be our 1, 2, 3, 4, 5. Okay. So I am going to pull this across up to this, not here, up to this. Now, the reason is, so these are called forecast horizon, and this is called terminal period. So in our chapter, we'll see that we will have explicit forecasts. So that means forecasts for each individual period, 1, 2, 3, 4. But according to DCF, discounted free cash flow, discounted cash flow, the farm value, the value of the farm is equal to present value of expected free cash flows to the farm. And we assume that a company will continue to generate free cash flow in perpetuity, but we cannot forecast cash flows forever in perpetuity. So what we do, we make some simple assumptions, and then we say after the forecast horizon, in this case after year 4, that our free cash flow will grow at a constant rate, which we will notate with the letter G. And then we will be able to find out the present value of all future cash flows from this period to the perpetuity at the end of year 4. So let me write this down for you, and then you can also find out the detail in this node here. So to find out the present value, this present value of terminal free cash flow. So what we have to do, so the terminal value of T minus 1 will be our free cash flow to the farm of T divided by our RW, which is the discount rate, minus G. And what is G? G is the growth rate. Growth rate of free cash flow to the farm in perpetuity after the horizon period. So what that basically means, we will forecast, or we have forecasted free cash flow to the farm individually for each year up to year 4. And we will make an assumption that after year 4, free cash flow to the farm will increase or will change at a specific rate of G. It could be 1%, 2%. In this problem, it says it is 2%. It could be some other number too. And we are going to use this formula to find out the present value of terminal free cash flow. So that basically means we will be able to find out the present value of all these free cash flow to the farm starting in year 5 using that formula. And that present value will be at the end of year 4. So we need year 5. We'll use year 5 free cash flow to the farm in that equation. So you see it is T. So T is year 5. And if we use year 5, we'll get the terminal value at year 4. T minus 1. 5 minus 1 is equal to 4. And after that, what we have to do, we have to calculate the present value of the terminal free cash flow. because it is at the end of year 4, we'll follow the same process as we followed here to calculate the present value of individual free cash flow. That means we'll apply this formula again. So let us do this. Before you do that though, we need to calculate the cumulative present value of horizon free cash flow to the firm. Horizon free cash flow is this individual free cash flow. So, and this will be at the end of 2018 in this cell. So sum this, and then present value of terminal free cash flow to the firm. So there are two things. One thing is present value, another thing is terminal free cash flow to the firm. First, we'll calculate the terminal free cash flow to the firm using this formula, and then we'll use this formula to find out the present value of this value. So this is our terminal value. So in this cell, which will be our free cash flow of T divided by open parenthesis, our RW, which is the discount rate, minus our G, which is the growth rate, close. So this is our terminal value at the end of year 4. We have used year 5 free cash flow to find out the terminal value at the end of year 4. And then we have to calculate the present value of this because it is at the end of year 4. We'll discount it for year 4. So I'll double click on this, close this entire thing within parentheses, divide by open parenthesis 1 plus our discount rate, close, raised to the power our year 4. Remember year 4, because this cash flow before the discounting is actually at this point of time. So hit enter. And then your total farm value will be sum of all these two numbers. And then NNO. NNO is given to you, net non-operating obligations is this number. Farm equity value will be total farm value minus net non-operating obligation. Your shares outstanding is given to you. This in million, these are also in millions, so you are good. Stock price per share will be your farm equity value divided by your shares outstanding. 151.89. So I will show all these up to 2 decimal place. Okay, let's see what is happening here. Okay. Okay. Now, so we estimated the value of a share of Home Depot. Home Depot stock closed at 190. So I'll let you guys answer this question by yourself. The next question I'm going to work on is question 4. Question 4 is telling us we have to use the parsimonious method and estimate share value. So we have to do this also in Excel. So I'm going to copy all these, Control-C. Let's see if it copies correctly. It did, so you're good. Let me, okay. So I think we are, let me see here. Make it look a little nicer. Okay, and then our consolidated balance sheet. Okay, I'll copy up to this. And then I'll manually copy this one, which I missed. Okay, I'll undo this. I'll just write down three manually. And then I have all this. Okay. So first we have to find out net operating assets and net non-operating obligation as before. Okay, so I am going to go back here. Actually, problem 1. I'll copy this, Control-C, and paste here. So to find out net operating assets, we need to find out operating assets and operating liabilities. Okay. So our operating assets is equal to sum our receivables, our inventories, prepaid expenses, property, intangible, goodwill, deferred. That's it. And then our operating liabilities are starting with accounts payable, accrued liabilities, income taxes, deferred income. That's it. And net operating assets is equal to operating assets minus operating liabilities. Okay. Now, non-operating liabilities equal to sum. First is current portion of long-term debt, notes payable, long-term debt. That's it. And the non-operating assets, some our cash and cash equivalents, our short-term investments. That's it. And non-operating liabilities minus non-operating assets, that is our N&O. So in 2 decimal. The next question is net operating profit after tax. So again, so I'm going to copy this, Control-C. So because we have to calculate the same variables to find out the net operating profit after tax. The net operating profit before tax is equal to our sales minus cost of sales minus our operating expenses. So which are this, actually. So these two have been added here, so I can just subtract this. So that's it, our net operating profit before taxes. So pre-tax net non-operating expense, this will be our interest expense, other expense, income before income taxes. Okay, so sum these two items. Okay. Note here that the numbers within parentheses means, the numbers with negative sign means income. Otherwise, it is an expense. Now, taxes on operating profit is equal to our tax expense, which is this plus our pre-tax net operating expense multiplied by our tax rate, which is 22%. And net operating profit after taxes is net operating profit before tax minus taxes on operating profit. So again, 2 decimal. So I did that. Now what we have to do using the parsimonious method. So what parsimonious method basically means is we have to use two ratios, specifically NOPM, net operating profit margin, and NOAT, net operating asset turnover. We have to calculate these ratios based on current year, and we have to use that to create our forecast for the subsequent years. So this is explained in more details in, you will see if you, I think you should review them, of course. Excuse me. Parsimonious method. Yeah, here, parsimonious model forecasts, page 13.5. So let me go back to Excel. Okay, we have to copy some additional information, the assumptions. I'll copy this, Control C. Now paste here. And then I'll copy this. Okay, so what I have to find out is sales for 2019, it is given. So 32, so this cell. And then I'm going to erase this dollar sign. Highlight these cells and on your keyboard, press delete key. Now enter equal. It says sales will grow from 2020 to 2023 at 8%. And after that, so that means for the terminal period, it will grow at 2% each year forever. So these times 1 plus the growth rate, 8%, and I'll press F4, or you can manually enter dollar sign for both the row and the column. Close, hit enter, and then I will pull this formula across up to year 2023 only. Now, when you see these no need to get worried, because this basically means you need to enlarge them to see them. Now for the terminal period, this times 1 plus your terminal growth rate. Now your NOPAT. So how can you find out NOPAT? You can use NOPM, net operating profit margin, which is equal to, again from chapter 3, module 3, you can see net operating profit margin is equal to your NOPAT divided by sales. So, and we have to use the 2019 rate. So I'll delete this, enter equal sign, calculate the NOPM. So our sales divided by, sorry, our NOPAT, this is our NOPAT divided by our sales. Enter. So again, this I cannot see because I need to enlarge them. So this in percent, 10.24%. Similarly, net operating asset turnover. So this is equal to your sales over net operating assets. So I'll delete this and enter equal. Our sales is this divided by net operating assets, which we calculated here. Again, this should be a ratio, so it will be a number, comma, up to 2 decimal is fine. Now our NOPAT, we are going to calculate so our NOPAT is 10.24% of sales. So sales times this NOPM. I'll lock this cell, hit enter, and pull across. And I can also select without formatting. This number are not visible very nicely. I can increase the font size and type also if you need to. Okay, all of this should be 2 decimal. Now net operating assets will be our sales divided by our net operating asset turnover. Lock this cell and then pull across without formatting if you want to. And then I can actually highlight these cells, click on this painter brush and click on this cell, and it will see all the formatting will be applied to all these cells. A shortcut to quickly apply formatting. So we found out all these. Now we have to solve part D. So for part D, what we have to do, we have to use these assumptions to calculate the value of Nike's common stock. So I'm going to copy this, paste here. get rid of the $sign. Now our increase in net operating assets, I'll start from 2020. So as before, 2020 minus 2019. And then pull across all the way. Free cash flow is our NOPAT, which is this minus our increase in net operating assets, which is this. And then I'll pull across. And our present value is equal to our free cash flow divided by open parenthesis 1 plus our discount rate. I will lock this cell, close, raised to the power this year. So this will be replaced with number 1. So 1, 2, 3, 4, 5. So let me do one more thing. As before, I will highlight these cells and then double click on this painter brush. And then, yeah, so that these numbers are visible more clearly. Okay, so I calculated this and then I will pull this across up to year 4. Remember, for year 5, we have to apply the terminal value formula. So cumulative present value, this will be the sum of all horizon up to year 4, free cash flow. And then present value of terminal free cash flow. So again, first we'll calculate the terminal value, which is our year 5 free cash flow divided by open parenthesis, our discount rate minus, scroll up, our terminal growth rate, 2%, close. So this is our terminal value. Now, one more thing is we have to find out the present value of this. Remember, we have used terminal value 5, free cash flow. We have used year 5 free cash flow. So this cash flow, the terminal value is actually stands at the end of year 4. So we have to discount for 4 years. So I'll double click on this and close the entire thing within parentheses. Divide by open parenthesis 1 plus our discount rate, close, raised to the power, this 4, and hit enter. So if it is not very clear to see these from here, you can also see the formula from this, plus hit enter. Now total farm value is the sum of these two. And then less NNO. So our NNO is, let's see, what was our NNO? This one. We calculated actually. So, and then equity value is your total farm value minus your NNO. Shares outstanding is equal to this in million. Our numbers here are also in millions, so we are good. Stock price per share, farm equity value divided by number of shares. So 49.78. So, and then there is theory question here. So I'll let you guys work on this. Now, question 5. I'll open another empty sheet, rename it as 5. So 5 is asking us estimate share value using the DCF. So we have to actually do a similar thing with different numbers. So let me, slightly different actually. First, we have to forecast the terminal period values, assuming the following terminal period growth rate. So I'll copy this. Okay. And then I'll copy these. So we have to find out the terminal period using this terminal period growth rate. So this is actually easy. So I deleted these number zeros. So our cells will be these times 1 plus this rate. And I'll lock this. I don't have to lock actually. There is there is nothing to pull across. And then NOPAT times 1 plus the same, and net operating assets 1 plus the same 1%. So this should be in 2 decimal place. Okay. Now estimate the value of common stock. So these are the assumptions. Copy again. And this is okay. Now I'll get rid of this dollar sign. Now my increase in NOA, so as before, start with 2019. NOA this minus this, 2019 minus 2018, pull across. Now free cash flow, again from 2019, our NOPAT in 2019 minus our increase in NOA in 2019. Now present value as before, this divided by 1 plus our discount rate log close raised to the power this, and I'll replace these numbers with 1, 2, 3, 4, 5. So this will be 1, 2, 3, 4, 5. And then I'll pull across up to 4. Accumulate them. So it'll be sum of these 4 free cash flows and present value terminal free cash flow. So I'll take the free cash flow to the farm at the end of year 5, divide, open parenthesis, discount rate minus my terminal value, this, close. Okay. Now this is my terminal value. We have to find out the present value. So double click and close the entire thing within parentheses. divided by open parenthesis 1 plus the discount rate close raised to the power 4. Again, you can see the formula from here too. Okay. Now, total farm value will be sum of these two numbers. Our NNO is equal to net non-operating obligation. Our NCI is equal to non-controlling interest, this number. Our farm equity value will be total farm value minus NNO minus NCI. And then shares outstanding is equal to this in million. Our numbers are also in million, so you're good. Stock price is equal to our equity value divided by shares outstanding. So 64.40. So all these need to be entered into decimal. Okay, I will do this way. Okay. Next, part C is telling us Colgate-Palmolive stock closed at 66.7 on February 21, 2019, the date the Form 10K was filed with the SEC, meaning all this information that we used was available to the market participants, like financial analysts, investors. How does your valuation estimate compare with this closing price? Our closing price, this is the closing price, and our estimated price is 64. So which is lower than this. So it will be lower. The forecasts you completed assumed a terminal growth rate of 1%. So this is the terminal growth rate it is talking about. What if the terminal rate had been 2%? What would your estimated stock price have been? So all you have to do, if you have done this correctly, like locking the correct cells and things like that, all you have to do, change this 1% to 2%, and you should get 79.77. And you will enter this here. Now, what would WACC have to be? Remember, the WACC is this 5.7%, but it is asking what would WACC have to be to warrant the actual stock price on February 21, 2019. So what it is actually telling us that when we used 1%, so I'll enter 1% back again, this is the price we got. But at that time, the market price was 66. So we have to find out the WACC that will lead us to a price here equal to the market price, so 66.7. So you can experiment with different numbers manually. For example, so it is 5.7 and it is 64.4. And you want a price higher, 66.7. So what you can do, you can start lowering the discount rate. So for example, instead of 5.7, you can say 5.6. So no, not yet. So again, 5.5. So 67. So let's say 5.4, 69. So we need to increase. So our original was 5.7 and we got 64. We need 66. So let's try 5.6. So it did increase. Okay, so let's try 5.65. 5.55. 66.77, close. But we can also use a tool available in Excel. For example, go to data, what if, goal-seek. And then it says set cell. So I want this cell equal to how much? 66.7. So I'll write down 66.7. So this is the cell, needs to be equal to 66.7 by changing, click on this cell, the discount rate, WACC, and push OK. Okay, and you'll see this is the number. If you want to see more decimal, you can actually look at here, 5.5543. So 5.55. That is it for today. I will see you in the next lecture video. Thank you very much. Have a good rest of the week. Bye.